So I want to introduce you all. Welcome to our BiSGroups today. And we have with us to help us with our financial understanding, Tom Seeko and CJ Burnett. Tom Seeko has worked within the veterinary community since 2014. He and his team at Florida Veterinary Advisors help associates, practice owners, and their teams find out the next step to take with their finances. Tom is a podcast host on the Smarter Vet Financial Podcast. He's a national speaker, publication author, VBMA speaker, financial advisor, and certified exit planner. Tom wants to help nourish the veterinary community so they have less stress and increase their confidence around financial decision making. He is married with a daughter and a little Maltipoo, Theodore. CJ Burnett. Although he is an analyst at heart, CJ enjoys working directly with veterinarians on their financial plans and feels most comfortable speaking in front of large groups of people. That's a unique trait. He is one of the founders of Florida Veterinary Advisors. He speaks on many financial and business topics across the U.S. and is a host of the Smarter Vet Financial Podcast with Tom. CJ does not want to only help people with their financial plans. He wants to change what's possible for them, to show them how to master the short game for them to win the long game and live incredibly fulfilling lives through impacting their communities. Welcome to Tom Seeko and CJ Burnett.
Well, thank you. So I guess I'll jump a little bit right into what we want to present today, because this is going to be mostly along startup concepts. Now, I will tell you that as far as like hard and fast rules, I'm probably not going to give you a whole lot of that today. The next 2 to 3 presentations will be focusing more on the hard and fast rules. I think today is kind of more of the introduction to, like, whenever you're starting a business, what kind of mindset we want to have, because a lot of the times people start businesses without really understanding exactly what how the day-to-day really needs to, what they need to focus on. So I might have some interaction since this is a shorter presentation, right? Between 20 and 30 minutes. And I think maybe what I'll do is I'll kind of go through it kind of a high level, and then give you guys at least a little bit of a time to come back around with some question and answer. If you really are like, whoa, time out, I really want some clarity on something, this is a small enough group where you can feel free to kind of say, if you want to need clarity, just say something. Hey, hold on, CJ, time out. What did you mean by XYZ, or whatever kind of that concept. Now, when it comes to starting a business, recognizing that there will be a day that you won't be an employee, you won't be a business owner, you won't, like, there is a time in our lives where we what we would call become financially independent. A lot of people think independence comes when we get to 18, 19 years old, and now we have like a paycheck and we're able to pay our bills on our own. And then there's definitely some independence there, but true financial independence comes when my bills are paid, whether I work or not. In other words, I've been able to build up a balance sheet. I've been able to build up enough wealth where, regardless of what I do today, tomorrow, next year, 3 years from now, 10 years from now, my bills will get paid from my wealth, and my work is purely only something that I do with my time. So when we start a business, a lot of the times we really are in a mindset that is from an employee's mindset, right? We were an employee, now we're going to go start a business, right? And we're going to go be our own boss, which sounds incredibly awesome until we find out that there's all these other caveats to that. Maybe some of you know some of those downsides. But today I'm going to spend more time on, like, how do we position our minds in the form of getting in a place to think more like an Elon Musk and less like an associate at a veterinary practice. So there is a podcast. We host a podcast called the Smarter Vet Podcast. Smarter Vet Financial Podcast. It's financial mostly, but we also talk about behavior, psychology, because finances, money doesn't work like math. Money does what we tell it to do. And I think especially when we're business owners and as we start businesses and start creating things like entities and organizations, then there's all these other facets of life that start getting introduced to what we're doing on a day-to-day basis, right? It used to be you clock in, you clock out. Now, if you become a business owner, if you open up a startup, if you start a business, and you're really the only employee in that business, then really we don't own a business. Really, a business owns us, right? Because we have some control over things, but then we don't, because at the end of the day, you can't just quit forever, right? Your bills aren't going to be paid forever. You're going to need to work at some point. The Smarter Vet Financial Podcast, we put this together purely as a way to give people an alternative method to information, an alternative means to information that they're not going to find out there on Google or YouTube or anything like that. So that's really what we try to focus on in that presentation. Now, Tom and I, we're financial advisors. We're licensed as financial advisors. We're, Series 7, Series 66. We do wealth management. We do insurance planning. We do financial planning. We do 401ks and group benefits and all that kind of stuff for businesses. We are also certified exit planners, which we actually got certified in working with business owners to learn how to exit their business. And some people say, well, if we're talking about startups, then why would someone need to know about exit planning? Well, because usually an exit plan starts at the beginning, just like retirement planning starts when we start working. Everything that we do has to have some sort of idea, keeping in the back of our minds that we got to start with the end in mind. Got to start with the end first, and then that allows us to back into the right steps and actions that we have to take today in order to make things happen. So we're a national planning firm. We're in over 40 states. I don't remember how many, but it's a lot. I just know that I take a lot of CEs to stay in all those states and pay lots of fees in all the different states. So this is Tom Seeko. He's one of the founders, one of the advisors. We actually both got a finance degree from the University of South Florida. He loves soccer. Like if you want to keep him on the phone for like 20 minutes, just mention soccer. He'll talk about it, talk your ear off. Loves to read, loves to self-educate. He was a band nerd. He was a band nerd in high school. So some of you probably have that in common with him. So I was actually an orc dork. So in my high school, if you were a band nerd, right? If you were in band, you were a band nerd. If you were in orchestra, you were an orc dork. I was an orc dork. So we were on opposite sides of the spectrum, Tom and I, in high school. We didn't go to the same high school, but we're both certified exit planners. I actually majored in violin performance in college for 2 years before I switched to finance. Some people say that that's like a complete 180. It's not. They're actually very similar. So there's a whole thing where when you're analyzing pieces, especially in music, financial stuff is very similar in how you use and how the brain is used, especially when it comes to jazz composition, which I was a jazz comp minor. So let's start with the vision and mission of so you started a business, you're starting something new. Maybe you're the only one that's in the business, right? You actually kind of like you own a business. You've started an entity with your CPA or with an attorney. And the whole run up of this is, we're going to be like a mobile practice, or we're going to have a specific type of business model that allows us to travel, allows us to go to different places, to meet people where they're at. And we're going to have a business model where it allows for your lifestyle to be different than what you were doing before, or perhaps it allows for a lifestyle that that you like. So having an idea as far as what kind of vision that you've set out for yourself is good to know, like over the next 6 months, but also if we can take a step back and think about what kind of vision do we have for the business? Because if you're the only employee, like ever in this business, you don't own a business. You can't go to somebody down the road and say, hey, I'd like to sell you my business. And then when they turn to you and say, okay, great, how many employees do you have? And you say, I'm the only one. That's kind of hard to sell, right? So no one's going to buy a business from you when you are the business. You are the only one working in the business. There's really nothing that they're buying. They might be buying like records. They might be buying a phone number that maybe you get a lot of calls from people, right? Maybe they're buying a phone number it's like almost like a lead generation, but there's really nothing that they're buying. And so to really think and create a vision of what do you see this business turning into, because it can't start and stop with you. It can start with you, but it can't stop with you. We want to start thinking about ways on how we're going to add people into the business, personnel, how we're going to be able to add a culture, bring on multiple people inside of this business, create systems in place, marketing systems, patient systems, processing systems, payment systems. As we create systems inside of businesses, because really that's what businesses end up being. And businesses end up being accumulations of different processes. So as we start thinking of the vision of what we want to be, how many people do you want to end up hiring? What are they doing? There's something called an organizational chart. If you've ever Googled an organizational chart, like that'll give you an idea of who goes where, and which lanes can you pick people to be in that would create efficiencies inside the business. And over time, I'm going to show you how the transition of your duties, your job as an owner, as a startup owner, should change from where you're at currently, depending on where you are. I don't know. Maybe you're on the startup side, and how it's going to transition over time. So let's talk about the two different types of business models. So there's two types of business models that we commonly refer to. The first one is what they call a genius model. The second one is what they call an autonomous model. A genius model is effectively a business that relies on a genius, right? It relies on you. And so a lot of people say, oh, I want to be the genius model. It's like, well, yeah, but like you don't, because the genius model, if it's always relying on you, then that means you can't go do whatever you want whenever you want. And remember, the idea of financial independence is my bills are paid and I don't have to work. That's financial independence. I want a business that can produce an income to me without me working. So usually when we start a business, we start and the business effectively owns you. That's all the way to the left on this graph here. You effectively are the business. And then over time, you want to try to hire people, create systems, create a culture within a business, within a practice, where you start working, you're still working in the business, okay, but you're not now the only person working in the business. You have a specific job that you've got. And usually what you want to do is you want to carve out those duties that you love doing. And you want to find the people that like doing the things that you don't like doing. When Tom and I got together, we started working cases together back in 2013, 14, whenever it was. Tom came to me. He says, hey, I'm working on this case. I'm working on this planning case. There's some parts to this that I don't like doing. And I'm like, well, what parts do you not like doing? He's like, I don't like doing this part. And I don't like doing this part. And I go, that's fantastic. Those are the two parts I love. And so as you work in the business and as you hire people, you want to start thinking about what are the things in the business that drag my soul down? What are those things that I really don't like doing that just really boggle me down? Now, maybe the things that you don't like doing, or maybe they're even things that you're neutral about doing, but they're easy to do, and it'll be easy to find somebody else to do them. You want to focus all of your time and all of your energy on the things that make the most amount of money, because at the end of the day, we have to be profitable. The more profitable we are, the more sustainable our businesses. The more sustainable our businesses, the more we can help the communities that we're in. Profits are not bad. Profits are good. We want to be profitable. We want to focus on how to be massively profitable. We want to try to delegate those things that are not allowing us to be profitable, and maybe hire somebody who we can pay a lower amount of money than what it's costing us as owner operators, and hire those people, because they're going to be able to be put to work. You're going to pay for their time, and they're going to be able to make you more efficient as a business. Then as you hire more people, you find areas for them to go, because hey, I don't like doing this. I'm going to hire somebody to do this. Hey, this duty over here is actually dragging me down, and I need to hire somebody to make sure that this gets taken care of, because it has to get taken care of, but it's not a massive priority, and it doesn't have to be done by me. And we're going to move more towards where you're starting to work on the business. Maybe you almost peel yourself out, where you're not even seeing patients. You're not even doing a whole lot of the day-to-day. You're just orchestrating. And I think during this transition, our duties and our mindsets go from being a veterinarian first and then a business owner second, right? When the business owns you, that's kind of where your mind's at. Over time, what we're trying to shift, we're trying to flip the script. We're trying to make it so that we're business owners first and veterinarian second. So if you want to see patients, great. See patients whenever you want to, but you don't have to see patients, because you've already hired enough vets. You've already hired enough staff where your business can operate on its own. And the ultimate goal, the time that that you've actually arrived in your business, is when you're in Fiji, right? You're in Fiji. You're not in the business. The business is working. People are working in the business. The business creates profits. You're earning those profits. Money gets deposited into your bank account systematically every so often, and it's like clockwork. And you can be in Fiji, or you can work. You can choose. You do whatever you like, whatever your heart. And if you want to go to Fiji for a month, for 6 months, for 30 years, right? That they would call that retirement, right? Getting in a position where now you own the business doesn't own you, and the business is providing for your lifestyle without you having to work a whole lot in it. I'm going to pause. I tend to talk fast. Some people think that that's like when I speak in front of groups, I just talk fast. No, I just talk fast all the time. So I apologize. So exit. At some point, if you build a business where you can be in Fiji and income still comes in, profits are still being created, you've got talent inside the business, you've got executives, you've got people that are running that business. It's a well-oiled machine. And even if you left for 6 years, you could come back and it's still running and it's still earning you income. At that point, you actually own a business that is sellable. And that's when we start thinking about, how are we going to exit? So exiting a business means selling it. That's all it is. It's just selling it. And there's 3 ways to exit a business. You can either sell it to somebody who is internally, like a veterinarian that you're working with inside the business, multiple people inside the business. You can sell it to an outsider, so a corporation or VC group. Or the third thing is you can basically die owning it. Like maybe you're planning on exiting the business when you die. You're going to hold on to it as long as you possibly can. And some of you might be thinking, I don't think that sounds there are some people that will literally plan, and it's okay to do this. It's okay to plan to hold the business until they pass away. And maybe they're going to leave it to their kids, or they've got some sort of charitable wish that will happen whenever they do actually pass away. But nothing stops them from holding on to the business until they die. So you sell to an insider, sell to an outsider, or you die owning the business. But it's really hard to have any sort of value to a business unless that business is completely independent of you having to work in it. Because why would I buy your business if I just got to buy your business to work in your business? I didn't buy a business, I bought a job. There are 3 parts to our financial lives. First one is what they call accumulation, right? As you build the business, you're building wealth, you're accumulating money, you're accumulating savings. Hopefully you're accumulating savings outside the business, not just inside the business. You're using the business to build your personal balance sheet so that over time, as your personal balance sheet grows, your dependence on selling the business is being reduced. I can't stress that enough because I meet so many business owners where they're constantly thinking that whenever they sell their business is going to be their retirement. And then whenever they get to that time when they want to sell their business, they're realizing that it's not going to be enough. So the accumulation of wealth outside the business to reduce the dependency of the sale of the business is the first phase. Then they usually sell their business. Then that's what they call retirement. I don't like that word. That word's like icky. Like I feel like retirement because it sounds so like for some people, whenever we're younger, it sounds so far off in the distant future. It's like we just can't grab it. So instead of retirement, think of it as financial independence. I would like to get people to where they're selling their business in their 40s and they're done. They can work if they want, but they don't have to. In retirement is effectively where you're now taking the accumulated wealth and you're figuring out how are you going to create an income from it. And then the third part is retirement completion. Some people want to leave no money behind. Some people want to leave a ton of money behind. It kind of depends on what you want to do as an individual. There's no right or wrong answer to this. And so recognizing that these three different pieces are what we've got to plan for, or at least understand on a deeper level for each individual in order to create a vision and a mission to build a business that they want. This is the startup. This is where you start thinking about how these things are going to work. Now, there is something called a gap, a financial independence gap. And this is something you want to sit down pretty soon and do. You want to figure out what this would look like. The first thing here is there's a certain amount of assets that are needed for financial independence. Okay, so there's, here I just put an example of say $6 million, right? Assets needed for financial independence. We know that at that amount, this person is going to be good in retirement. They'll be able to, like, if they got to 6 million in their 45 or their 50 or their 55, whatever it is, right? They get to 6 million. They know that that's what's required for them to become independent. And then there's a certain amount of retirement assets or even investable assets that they have that they hold as an individual. That's not correlated with the business, not in the business, but they're individually held. They might be a brokerage account, might be liquid stocks, liquid bonds, whatever it may be. There's assets, there's investments, might be real estate. I mean, some people invest in real estate. And then there's a certain amount of value that comes from their business. When you're a startup, there is no value, right? You've got to create the business, get it to where it's sellable, get it to where someone else would want to buy it from you. That's when you have an entity value that you can actually enjoy some sort of sale from, where you can sell that business to somebody, to another veterinarian, and they're going to take it from you. So there's a certain amount of business value that you hold. If you added both of those, all of those assets together, right? Everything that was individually held and everything that's in the business, right? Then there's some sort of gap between the total amount of that and the financial independence amount that you need. And that gap is what we want to focus on. That gap is how we're going to figure out, okay, how do we close that gap? How we can either do, because we can do a lot of different things. Either we can try to grow our personal assets, or we can try to grow the business value, or we can even consider different ways where maybe we can work with less, right? Maybe we don't need 6 million. Maybe there are ways that we can figure out how we're going to get income from our assets where I don't need 6, maybe I need 5. And if we can reduce the assets that are needed for financial independence, then we can get people to that spot sooner. And so this is kind of the mapping it out in your head. And if you do an inventory and you're like, oh, geez, I have $6, that's okay. Right? If you're starting at $6, like everyone's got to start somewhere. Don't feel bad. Take an inventory of your personal assets. If you just started your business and there's no value to it, that's okay. Right? If you're the only one, you got time. And it's a whole lot of fun, okay, to build a business. because you can really impact people's lives in a way that no one else can. As a business owner myself, I love how I can provide life-giving careers to my staff. And it is the coolest thing because your staff, they have ups and they have downs and they're living life too. And, their junk can sometimes be your junk. And it's kind of beautiful that way because you have the ability to really help people live a different life than they otherwise would have. And so, and you bless them financially, you can bless them as somebody who is their boss, because, a lot of people go to jobs where they're not necessarily, they don't feel that way, right? They don't feel like family. They're not treated that way. And so you have the ability to provide that for people. Now, if you don't have enough, whenever you get to retirement, where you need to, like, some people get to a spot in life where they might even be in their 50s and they experience a health problem and they're forced to retire. Like, they didn't want to retire, but they're forced to retire because they literally just can't. They usually call that disability when they get disabled. I don't like calling it disability because sometimes, like, they can still work a little bit. Maybe they don't qualify for disability benefits under insurance companies or under most insurance companies. And so they're kind of stuck. They're kind of stuck in a forced retirement. And so if we don't have enough money, whenever we get to that spot where we can no longer work, we either have to work longer, we have to take more risk, right? We take the investments that we have and we try to take more risk in order to get them to grow faster, or we have to figure out how to live off of less, right? There's people that are pushed into a forced retirement. They're stuck in a place where, they may have to just figure out how to live off of less, which is not fun, but that's kind of the reality that some of us face, especially if we didn't prepare for disability, if we didn't prepare for an early retirement, or prospects of a health issue happening, then some of us are just going to be forced there. When it comes to your financials, you really want to understand the story that the numbers tell. Does everyone like stories? Anyone not like stories? Let's start with that. I've found that very few people don't like stories. And if you can try to look at numbers, a lot of people get scared of numbers. Say, oh, math, algebra, right? Don't be scared of it. Start learning it and start considering that your numbers can tell a story. Look for the story. Now it becomes more of an exciting thing to learn, less of this mathematical drudgery. Because really, I can tell you right now, it's not the math that you're interested in. It's the stories behind what your financials say. There's a profit and loss statement, right? You want to know everything about your profit and loss statement. If you're looking at your profit and loss statement, you don't know what something is, you ask your accountant, ask your bookkeeper, ask Google, find out from somewhere, learn everything you possibly can about your profit and loss statement, and know that the statement that you see, people go, well, is this a good profit and loss statement, or is it a bad profit and loss statement? The answer to that is it depends. You want to see trends over time. What is your P&L doing? What's going up? What's going down? If things are going up or things are going down, can you guys still hear me? Okay. If certain things that are going up, certain things that are going down, you really want to recognize. I'm noticing my microphone is doing some weird things. Can you guys still hear me, or did it change?
I think we're hearing you okay, CJ.
Okay, cool. So as you learn the profit and loss statement, as you see where numbers go up and numbers go down, that should give you be a good indicator as far as like what's happening. What's the story behind your numbers? A balance sheet. You want to know what a balance sheet is. A balance sheet is not as important as the profit and loss statement, but this allows you to see effectively the status, the financial health of an organization. It's a snapshot in time. It's your assets minus your liabilities. I think I might have actually put that in a spreadsheet or in a slide here. But understanding your balance sheet, when you sell a business as a veterinary practice, the balance sheet matters less than the profit and loss, because ultimately valuations come mostly from profits. If you're in a business, a business model where it's what they call fixed asset intensive, in other words, you need a lot of equipment in order to do your exact type of business, your exact business model, then the balance sheet and the equipment that you hold does matter more in that instance. But mostly when people are looking at valuation of veterinary practices, they're mostly looking at the profit and loss statement. Tax returns. Tax returns are incredibly important. They might seem boring at first, as you learn like what a 1040 is, or an 1120S, or a K1, right? You want to be able to just go through and know the high level stuff, have your accountant do a 5-minute, 10-minute run through of your actual statement, start asking questions. What is this number? What is that number? The more you understand your tax records, the easier it is for you to buy a home. The easier it is for you to get a loan from a bank. I can't tell you how many times as a business owner, I've gone to do something. I've gone to try to either get a loan from a bank or do something for a business. And the bank comes back and tells me things about my financials where I'm like, I don't think your underwriter's looking at this carefully enough. And I've challenged banks. I've challenged people who are in these institutions where they might decline you or tell you that you're not profitable enough. And when you can navigate your tax returns better than they can, you're able to do a whole lot more stuff, and you're able to get a whole lot more stuff approved. I've even seen loans for nonprofits that I've worked for. These like these banks approve these nonprofits for these loans where no way that nonprofit was going to be able to afford it. And whenever I brought it up to the bank goes, ooh, you know what? Maybe our underwriter missed that. So, don't assume that the accountant knows everything, that the banks know everything. You really want to take some time and understand how your tax returns look. And just so then as you go throughout business life, you can navigate that. So real quick, I'll go through this really quick, really fast. Exciting businessy financial terms of P&Ls. Revenues and sales, it's basically what comes in. You have your cost of sales, cost of goods sold. You have your gross profit, right? So revenue minus cost of sales equals gross profit minus expenses. That equals your net profit before tax. You'll hear EBITDA a lot. EBITDA is a very common word that they'll use. It's earnings before interest, taxes, depreciation, and amortization. And then obviously you have your net profit before tax minus taxes. That equals your net earnings or your income. Illustration of a balance sheet. So more exciting accounting terms. I said it a couple minutes ago. K1, 1099, W2, 1120S, 1040. These are all things like if there were like 5 tax IRS-y terms that I would say you need to know, it's these. What is the difference between a W2 and a 1099? Because you might have somebody like that you hire in your business and you're like, ooh, do I hire this person as a W2 or do I hire them as a 1099? Well, there's actually IRS guides on how you do that. Well, my CPA should know that. CPAs are really good guides, but sometimes they're not going to know your business better than you. And the more you understand your business and how that translates into how you pay people, you're going to have a whole lot better of a time finding good CPAs. You're going to have, like, when you know these things and you talk to CPAs, I can tell you right now, within 20 minutes of a conversation, some people say, well, I don't know what's a good CPA or what's a bad CPA. Sometimes just knowing some of these terms, you'll tell a good CPA versus a bad CPA pretty quick. Illustration of a balance sheet. So I mentioned a balance sheet, assets on the left, liabilities on the right, net worth. So if I took all my assets, turned it into cash, paid off all my liabilities, whatever I stick in my pocket is the net worth of as an individual, but also as a business. We personally have have balance sheets, but then our businesses have balance sheets as well. And so recognize that you've got a balance sheet in the business, assets from the business, there are things that business owns, liabilities in that business, things that business owes, like a loan, and then there's a net worth. There's equity, net worth or equity. Those are commonly understood on a balance sheet. All right, almost done here. Recognize that establishing a specific culture, attitude spread from the top down. As you start hiring, recruit very specifically. Recruit based on skills, but also recruit based on personality. Recruit based on, like, there's so many things about a person that are like, it's not just can they do the job, but it's, you know, can they really integrate into a culture that you want? Hiring the right professionals. If you want to write these down, there's effectively a board of directors, if you will, that you want to have as a startup. You want to have an accountant. I put business. It might seem like ridiculous that I put business in front of all these words, but I did it on purpose. It's to make a point. I have met with business owners where their buddy in college was an accountant. And their buddy in college, who's an accountant, does nothing but like individual tax returns. And then I get their business tax returns, and it's a nightmare. Well, he's my buddy from college. Look, I know that. It's okay. Like, I know you guys used to have beers all the time and you know everything about each other. But like, at the end of the day, we really need an accountant that knows how to file business tax returns. We need a business consultant, or at least somebody that's going to provide as a CFO. Now, a chief financial officer, a CFO in corporations, their sole existence is to increase the profits. It's increase the bottom line of that organization. A CPA, an accountant, the accountant, oftentimes when you go to accountants, what's their primary concern? Their primary concern is to have your taxes be as low as possible, right? If you're trying to show if you're trying to pay the lowest amount of taxes, that means you're trying to show the lowest amount of profits. Sometimes your consultant, people will have an accountant that they elevate to the same level as like a consultant or a CFO, but your accountant is trying to show the lowest amount of profits. Your consultant is trying to increase the profits. There's a mindset that is kind of battling there. Right. And so you just have to be aware that sometimes you don't want to elevate your accountant to a consultant. Maybe you need to have a different consultant as somebody where your accountant tries to reduce your taxes, but your consultant is trying to increase your profits. A business attorney, a business banker or lender, a business financial advisor. A financial advisor that doesn't work with businesses oftentimes is going to miss an entire half of your planning. They're going to work on the personal planning side and they're not going to really touch on the business. Business insurance profession. So insurances, there's a bunch of different types of insurances, as you all know. You just want to be aware. So who coordinates decisions with all of those professionals? The unfortunate part as a startup, it's you. You're going to be the one that coordinates these decisions, and you're going to be the one kind of stuck in between all of them, trying to make sure that they're all communicating at least to some degree. Because when you make a decision in one area, and especially in the tax law arena, and you're working with your attorney over here, and then they make decisions, and then you find out that it had an effect on your taxes over here, and your accountant is like not aware of those, it could be bad. So you really want to start getting an idea, just high level, how you're going to get all these people to communicate and make sure that they're all working on your behalf. Obviously, we have a website you can go to, tons of resources. We have a YouTube channel, LinkedIn, Facebook, podcasts. I mean, we've got there's 7 CE presentations available on demand on our website, all on the financial business arena. So you can go there. And then this is the most exciting slide. And that's my disclosures. And I hope that this was helpful. I hope I didn't drone on too long. And I hope, I guess now I just open it up for you guys to ask me questions.